The Nifty 50 is under pressure as global investors react to a major geopolitical development. The United States is considering a policy that could impose tariffs of up to 500% on countries importing Russian oil. Although the move is aimed at Russia, its impact is being felt across emerging markets, including India, and this is now clearly reflected in Nifty's recent price action. India has become one of the largest buyers of discounted Russian crude since the Ukraine war began. This helped reduce India's energy import bill and keep inflation under control when global oil prices were rising sharply. However, the new U.S. tariff threat has introduced fresh uncertainty into India's trade outlook and energy strategy. Even though the policy has not yet been implemented, markets have already begun pricing in the risk of trade disruption and a potential slowdown in global growth. From a macro perspective, India still enters this phase from a position of relative strength. India remains the fastest-growing major economy in the world. Growth is supported by strong domestic consumption, continued government infrastructure spending, rising manufacturing output, and steady expansion in services and the digital economy. This strong domestic base provides a long-term structural cushion for the Indian market and remains a positive factor for Nifty. The banking system is also in its strongest position in over a decade. Asset quality has improved significantly, credit growth remains healthy, and capital buffers are strong. This strengthens the financial backbone of the index. Inflation has remained broadly stable, supported by lower energy costs due to discounted oil imports. This allowed the Reserve Bank of India to maintain a balanced monetary stance, supporting investment and corporate earnings. India's foreign exchange reserves also remain strong, giving the RBI the ability to manage currency volatility during periods of global risk-off sentiment. However, in the near term, Nifty remains vulnerable to global shocks. India imports nearly 85% of its crude oil from overseas markets. Major suppliers include Russia, Iraq, Saudi Arabia, the United Arab Emirates, the United States, and several African nations. Russia has emerged as one of the largest suppliers, accounting for roughly 35 to 40% of India's crude purchases in recent years. Iraq supplies around 20 to 23%, while Saudi Arabia contributes about 16 to 18%. The UAE provides 8 to 10%, with smaller volumes coming from the United States, Nigeria, and Angola. Any disruption in discounted Russian supply could push fuel prices higher, raise inflation expectations, and put pressure on the rupee. This would directly impact market sentiment and corporate profitability. Export-oriented sectors within Nifty, particularly IT services, pharmaceuticals, metals, and engineering, remain exposed to any escalation in trade tensions with the United States and Europe. In addition, Nifty remains sensitive to foreign institutional investor flows. During global risk-off phases, foreign investors typically reduce exposure to emerging markets, adding further pressure to the index. From a market perspective, if India is forced to reduce Russian oil imports, energy costs could rise by billions of dollars annually. This would feed into higher inflation and could delay future interest rate cuts by the Reserve Bank of India. At the same time, any escalation into a broader trade conflict would weaken global growth expectations, which would impact earnings visibility for export-heavy Indian companies. Structurally, India's growth story remains intact. Domestic demand, infrastructure spending, and manufacturing expansion continue to support long-term earnings growth. However, in the short term, Nifty is likely to remain volatile as markets track U.S. policy developments, crude oil prices, currency movements, and foreign investor flows. Until there is clarity on global trade policy, market sentiment is expected to remain cautious. The recent correction in Nifty is not a sign of panic. It reflects a rational repricing of geopolitical and macroeconomic risk. India's long-term fundamentals remain strong, but near-term volatility should be expected. For investors,
This is a phase to focus on discipline, risk management, and selective positioning rather than emotional decision-making.
Now, we are going to analyze the Nifty 50 index from a technical perspective. Let's start with the monthly chart. On the monthly time frame, we have drawn a highly accurate ascending channel. Drawing the channel correctly is extremely important because many traders wrongly identify trend breaks without properly understanding the structure of the market. At present, Nifty 50 is still trading inside its long-term ascending channel. The lower boundary of this channel is acting as a critical support zone between 25,500 and 25,530. That is why the coming week is extremely important. We must closely observe whether the market respects this channel support. This is a very sensitive zone for the index. Now let's move to the weekly chart. On the weekly time frame, the 21-week moving average is providing support near 25,630, and the ascending channel support is located around the 25,500 zone. So, we have two major technical supports converging in the same area. At this point, two possible scenarios are developing. Scenario 1, positive outcome. If the tariff-related issue gets resolved next week, the market may show some short-term volatility around the 25,500 zone and then rebound strongly. If Nifty 50 rebounds from this support, it could build the base for a long-term rally toward the 30,000 level. Realistically speaking, a 500% tariff is highly unlikely to be implemented. Scenario 2, negative outcome. However, if the tariff issue escalates further and geopolitical tensions increase, and if the market breaks below this ascending channel, then a major correction or even a crash could follow. In that case, Nifty 50 could gradually move down toward the 22,000 to 19,300 zone. So next week will be extremely important and challenging for the market. This period may determine the medium-term and long-term direction of Nifty 50. Traders and investors must remain highly cautious and avoid aggressive positions without proper risk management.